What's up everybody, Nate here, and it looks like the Federal Reserve just completely flipped on its monetary policy. In fact, the Federal Reserve Chairman Jerome Powell at a press conference yesterday just gave us a big hint on where interest rates might be headed next. And spoilers, they might be slowing down.
You gotta go slower.
So today I want to go over everything Jerome Powell just said about the Federal Reserve, inflation, and their monetary policy, and how all of this is going to affect our economy, our money, and the world economy in 2023. So here's exactly what Federal Reserve Chairman Jerome Powell said when asked if the Fed is going to reduce its interest rate hikes starting next month. It makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Now, the December meeting is December 13th and 14th, so we will have a lot more information on exactly what the Federal Reserve is going to do with its rate hikes. But basically what he is saying here is there is a really good possibility that the Federal Reserve could lower the amount that it raises its interest rates. So over the past few months, the Federal Reserve has been raising its rates by 0.75 basis points. That is a whole lot, and it sent the federal funds rate well over 3 and 4%, up from 0%. But Powell believes that the interest rate hikes are starting to work and are starting to have a good restrictive effect on our economy, meaning we could see a 0.25 basis point hike in December or a 0.5 basis point hike. So that would be a whole lot lower, and it means that the Federal Reserve is going to slow down. So I want to take a quick detour very quickly to talk about why the Federal Reserve believes that their interest rate hikes are just now having an effect on our larger economy. And the way that the Federal Reserve kind of measures this is with two major things. First and foremost, the Federal Reserve looks at price stability. So how fast are prices increasing in the United States? And over the last year or so, prices have increased a lot. Over the summer, inflation hit a well over 40-year high of 9.1%. Right now, though, inflation is around 7.7%, and we know that because of the Consumer Price Index. The CPI numbers come out every single month, and they basically take a basket of all goods and services and show us our prices for those services and goods going up or going down every single month. If they're going up, then that means you have price increases, i.e. inflation. Inflation creates a whole bunch of problems for your economy because it means the value of your money is going down, which means the buying power is also decreasing. You need a whole lot more money in order to buy all of the same things, so you have to either make more or companies have to reduce their prices, and we know companies can't really reduce their prices because they have increased costs because of inflation. So what they end up doing is paying people more, but then people make more, they buy more, and then you have even higher inflation. So you need kind of an equilibrium, and that comes with price stability. Once you have prices not really increasing crazy amounts in the United States, then you know that prices are stable. So over the last couple of months, the Federal Reserve has been keeping an eye on the Consumer Price Index, and prices generally in our economy have been coming down, although shelter costs and some food costs and energy costs are on the rise for most Americans. But generally, prices are starting to come down. Asset prices and commodity prices and housing prices are all coming down in the United States, meaning that as the Federal Reserve has raised its interest rates, that has meant that there has been a lot less spending, keeping those prices stable across the board. And then the other thing the Federal Reserve looks at is our job market, particularly the labor data. So do we have really high unemployment, and how many job postings are there in the United States economy? This gives a baseline for the Fed to figure out, well, is there too much money being spent on employment? If there is, then that means to the Federal Reserve there's too many people that have jobs, and that means there's too many people spending money, so they have to raise their interest rates so that way businesses get squeezed and start laying off people. And we have seen that a lot in 2022. Unemployment is also on the rise, not by a whole lot, but it is starting to go up slightly. So both of those things, prices being stable and the jobs numbers, are telling the Federal Reserve that they're headed in the right direction with their restrictive monetary policy and interest rate hikes. But the Federal Reserve has to be very careful because they don't want to just spike interest rates very quickly and too aggressively, making them way too high, because that would mean that our entire economy basically goes into shock and we have a lot less jobs and prices get way too stable all at once and people make way too much money or way too little money. So the Federal Reserve has to be careful of that, because if they do too much, well, it could send us into a recession with really, really high unemployment unemployment and people not able to spend any of their money. Jerome Powell added, quote, "Despite some promising developments, we have a long way to go in restoring price stability." So like I said, the Federal Reserve will most likely be raising their interest rates in the future, but they might be a little bit lower because now they're kind of gauging where the economy is at, and they want the economy to be strong and they don't want to send it into a recession. But they're still identifying an inflation problem, which we definitely still have. The Federal Reserve likes to keep inflation at around 2% in our economy. We always have inflation. Not a lot of people realize that. There's always an inflation rate because the definition of inflation technically is when the federal government increases the monetary supply. Every single time the Federal Reserve prints more money, you technically have inflation because now there's more money out there. There's more money for people to buy things. So that means that prices need to go back up. So you have inflation and you have that volatility in prices. But the Federal Reserve likes to keep inflation at around 2%. This means that your economy can grow. This means that there is money being printed and sent out for people to buy. And yeah, prices are going to go up, but it's not a crazy number. Right now, we're at 7.7% for inflation. So we are more than triple where we should be at. So inflation is still a pretty serious problem in our economy right now. So we could actually start to see lower hikes in the future starting in December. But what exactly can we expect to see into 2023? Well, Federal Reserve Chairman Jerome Powell answered this question saying, quote, "Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done." So that is kind of a good sign from Federal Reserve Chairman Jerome Powell. He also mentioned that the federal funds rate is probably going to have to be a little bit higher than what the Fed had anticipated in the past. So they were thinking that the federal funds rate was going to stick at around the 4.5 to maybe 5% mark. And we're right around the 3 to 4% mark right now. So that means we can expect a few more rate hikes into 2023. But now they're thinking that it might go just over 5% at maybe 5.25%. And it's going to have to stay there until we really start to see some massive impact and some massive strides on the inflation front. Jerome Powell was very clear. He said that they need to bring down inflation and their rate hikes and monetary policy are going to have to reflect that for the foreseeable future. That means we could see that federal funds rate stay at around 5% for a year or maybe 2 years. It really just depends on how quickly demand falls in our economy and prices remain stable. The one thing that you can take away from all of this is that the Federal Reserve and their interest rates makes our entire economy a whole lot more restrictive. And what I mean by that is they have a direct impact on borrowing money in the United States. So as the Federal Reserve raises its interest rates, that's going to make it a whole lot harder for consumers to get a mortgage and harder for people to spend on a credit card and harder for people to get things like an auto loan. So spending money is naturally going to go down, which controls prices. So if you have fewer people spending money, then you're going to have lower prices. It's also going to have an effect on businesses and investors because investors can't borrow as much money to invest in businesses. They're not going to be able to get as big of a return on their money because they're borrowing that money at an over 5% interest rate. So they have to see a 5% plus interest rate on their money, and most investors are going to avoid that because it's way too risky. So they're not going to invest. Businesses are not going to get that extra liquidity, and thus that's why you could potentially see lots more layoffs and unemployment into 2023. All of that again doesn't directly control prices in our economy, but what it does is force people out of jobs. And if people don't have jobs, then according to the Federal Reserve, inflation will come down because they won't be able to spend any money. Obviously, there are other ways to control inflation, not just this one monetary tool. Congress could step in to help in other ways to control inflation. We have a lot of supply chain issues in the United States and across the world. All of that is contributing to this inflation problem. But this is the only thing that the Federal Reserve can do in order to bring down inflation, so they have to continue raising their interest rate hikes, and they probably are going to keep them high for the foreseeable future. And to be completely honest with you, we have no idea what what the Federal Reserve is going to do next. They have said that they are going to be very slow on their interest rate hikes before. They've said that they're going to be very aggressive and have done neither one of those things. So we have to take everything they say with a grain of salt because they're looking at the live data, and they have to be very careful with what they say because they give investors and consumers the expectation and the confidence to go out and spend money. If they say things are going to be terrible and they're raising interest rates very aggressively and quickly, then investors are going to run for the hills, and so will consumers. So they have to be very careful with what they do. So what's more important is that you watch your money right now and kind of make decisions in preparation for whatever the Federal Reserve decides to do. I don't have a magic ball in front of me, so I can't predict and then make decisions based on something that hasn't happened yet. So what I am doing with my money and what a lot of people are considering is to just be careful with their investments and to be careful with their personal money management. We have no idea what's coming in the future. We don't know if there's going to be job loss. We don't know if the economy is going to explode because the Federal Reserve may reverse a lot of its policies, truly flip-flopping and actually lowering interest rates in 2023. We don't know what's going to happen next. But what we do know is that saving is going to continue to be important for emergencies and for the things that you want. You cannot take on additional debt right now because the Federal Reserve is raising its interest rates, meaning all of that debt is getting more expensive. This goes for personal consumption and for businesses. You also can't stop investing because if you do, then that means your money is just going to be losing more and more value to inflation. And one of the only ways to beat that is by investing your money into something that is going to gain value over time. And you have to be careful with your actual purchases. This is not the time to go out and blow money. You have to be very careful and you have to decide what you're going to spend your money on and be very thoughtful. Having a plan in place is going to be better than not having a plan at all. That way you are prepared for whatever the Federal Reserve decides to do next, and you can actually thrive in whatever economy our country ends up in. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.